This special podcast is brought to you by Futuregrowth Asset Management. I'm sitting with Vickers Furstenberg, who is a fixed interest portfolio manager. And we're going to talk a little bit around the flash crash that happened on the 24th of August. So that would be last Monday in the States, and how that impacted on the South African bond market. So just to put it in perspective, the flash crash is where there are certain circuit breakers that are inserted into the market to stop panic selling at certain levels. And we saw this play out in the American market last week on the back of fears out of China that growth was slowing. They had devalued the renminbi, and people thought once again the world was coming to an end. Because what did this do for the South African bond market?
Well, Candice, we actually saw yields rising, testing higher levels. Just to maybe put that in perspective, last week the 186, it's the bond that matures in 2026, a government bond, yield moved from an intra-month low of about 8.4% to just over 8.5%. So it's about a 40 basis point move, and most of that was linked to what you mentioned.
Okay, so that 40 basis points in the bond market is big, and that would be people selling out of the 186. Why would they be doing that?
In this case, it was obviously linked to, you mentioned China, it's linked to South Africa's, the fact that South Africa is a net exporter of non-energy commodities, with China one of its biggest destinations. So it's all linked to fear about China and all linked to its potential implication for us as a net exporter of commodities. And of course, I think against that background, also the fact that we are still running a current account deficit. Although it's narrowed in the last 2 years, especially the first half of this year, is that market perception. I think the market overreacts to these sort of things. It gets really very sentimental about these things, and I think the last week or so the market, I think, also ignored the fact that the oil price dropped sharply. So it's not just about commodities. I think one should look at energy versus non-energy commodities in the case of South Africa.
And so is the assumption when selling of this nature happens that it's foreigners selling out of an emerging market?
Well, I think it's easy to jump to that conclusion. We know that foreign investors were net sellers of SA bonds in August. If you look at official data, JSE data, it looks like around about 3 billion. But of course, there are local players as well. So could very well be local players as well, not just foreigners. But we've seen foreign investors selling assets globally, including emerging market assets, including local currency bonds, and South Africa obviously were impacted by that as well.
So what is the thinking behind that? Because our local bonds are giving you quite a significant real yield. So that is the yield above inflation, and the SARB has also demonstrated how dedicated they are to keeping inflation within the 3 to 6% band. So when you look at that versus what you're getting in developed markets, it's almost a no-brainer that you'd want to be in the South African market. So what is this fear temporary? Do they think they're coming back, or what would be a portfolio manager's thinking when he's selling?
Well, it's my view that these people use panic to respond to panic.
Explain that.
Well, we always told the South African bond market is relatively liquid. And typically what happens if you have a global event like this, there tends to be a risk aversion sort of approach that people follow, and if they do that, they think it's best to avoid those assets that even in the short term will give you a capital loss, especially if you consider what the currency is going to do. Keep in mind, if they look at local currency bonds, they need to take into account what's going to happen to the dollar returns as well, because they invested in rand. So if they have a view that the rand is going to depreciate because of this link to China, commodities and so on, then they need to sell an asset, and what they will, in this case, what they did is to sell SA bonds. It's also a relative play. At the same time, what we all saw happening is strong demand for US Treasuries, for instance. I mean, yields there went the other way. A clear indication that there's some risk aversion trade at play here, selling emerging market bonds, including South Africa, even though local currency yield is significantly higher than what's offered by most of these developed markets, but they just went for the lowest risk. I don't think it's necessarily a clever trade. It's a short-term trade, but it happens. The sell-off that we saw in August is actually very small if you compare it to what happened in May, June 2013.
What happened then?
Remember we had the Bernanke taper, when Bernanke sort of mentioned, listen, at some point we need to think about removing quantitative easing, start that process. We actually all knew about that, and they sold. I mean, the 186, the same 186 yield over that period went up by almost 200 basis points. The same happened earlier this year. Remember when we had the oil price dropping and then turning around in January? From that low, the 186 until recently moved by about 150 basis points. So that's a sort of volatility that we actually experience a lot in this market. So the 40 points that we saw last week or so isn't that much. It's still a big move, but relative to recent previous moves, it's not that big.
So if you'd been a smart foreign investor sitting on the side, you actually should have bought into our market when yields moved, because in fact the currency had weakened too. So
Yes.
you'd taken some of that currency risk off the table,
Yes.
and you were getting the improved
Indeed.
yield. So what did you do in your portfolios?
Well, we're obviously sort of longer term investors, so we actually used weakness to add to our positions. So we've been buying into weakness, into bouts of weakness. We're waiting for this. I mean, we have a large portfolio that we have to move, so it's not easy for us to sort of wait until it's too late. So we opted to add to our exposures the last 2 or 3 weeks.
Okay, and that's what you'd want your portfolio manager to be doing, buying when the price is low. Vickers, thank you so much for this fascinating insight into how international markets impact on South African bond markets.
You're most welcome, Ken.